Okay, so good evening, everyone. I hope that you are okay. Good morning, good evening. Sorry, good evening, everyone. So good evening, Kian. Thank you for saying me good morning, so I can. It's nice first, and secondly, yes, I can be sure that you guys are hearing me. Voilà. Good evening, everyone. I'm gonna mute all. And so we're gonna go back to what we were doing yesterday. So we were on this Gordon case, you remember, and we were building the cash budget, okay? So we have a company that bought some new fixed assets cash for 3,000 in April. The company wants a minimum of 10,000 cash balance at the end of each period. So we will usually use this assumption in the two cases we're going to discuss that the company wants to have a minimum cash balance, which makes sense, I guess. So we're gonna use this method, and so now what we need to discuss for the cash budget is how we handle the borrowings and repayments. Okay, so it is said that management plans to borrow no more than necessary and to repay as promptly as possible. So this case is simple. We're going to do another case just after. This part is a little bit more complicated, but still it's okay. I mean, it's and in between financial mathematics and management accounting. So in this case, it's quite simple. Okay, we just have to determine if we have an excess or deficiency of cash. And so we borrow if we need, and we repay as soon as possible. Okay, so the borrowings and repayments occur at the end of the month. Okay, and also interest must be paid, but they are paid only every quarter. Okay, so every quarter, so in March, June, September, and December. So it means that in our case, there will be a payment only in June. Okay. And so the rate is 12% per year. So we will consider 1% per month. Okay, simplified. I mean, the bank would do that. Okay, so just to remind you the assumptions we have. And so we can come back to the cash budget. So the cash budget, this is where we are. Okay, so we've been identifying that the cash balance. So in terms of method, what I did, when I pick up information from the operating budgets, I already copy past all the months. So I'm finished, you know, when I go take information from Schedule B, Schedule F, Schedule D, and that's it. Okay, these ones, okay, it's provided by our previous step when we did the operating budget here, okay? Then, okay, I know from the beginning, from the case that, so sorry, for the beginning balance, I go in the balance sheet of 31st of March, okay? So this is where I have the information about the beginning amount. So I try to put it in red when it comes from the balance sheet. We just read that we have new fixtures which are acquired in April, so we have to add 3,000 here, okay? And we also know that we need a minimum cash balance of 10,000. So this is a sort of a constraint that I have. And so I put 10,000 as something I need to have in my cash balance. Okay, so again, the cash needed here, the total cash needed is the sum of disbursements plus what I need, the minimum cash balance. So it's like I need to pay 69 for the month of April. On the other hand, for the total cash available, which is total beginning balance plus 56 46 46 cash receipt. So we have 56 available. And so here, the excess of cash or deficiency is the difference between what we have available and what is needed. Okay, and so we see that we have a negative amount. Okay, that could be also in the format parentheses. I didn't change the format here. Well, I mean, it's no big deal. And so we miss 13,000, right, for 450. And so this is April. So at the end of April, we're gonna borrow what we miss, right? So we're gonna borrow this amount. And so the ending balance will be what? Will be actually, I'm gonna follow the formula, cash available minus cash disbursement plus borrowing minus repayments minus interest. Okay, so basically what we can see maybe is that we take cash disbursement, so we don't take the minimum cash balance in the formula. Okay, and the consequence of this is that this is what we reach at the end of the process. Our ending balance is 10,000. So this is the amount we want to reach. Okay, so in this formula we just take what is available and that's what we have to pay, and then all the consequences of the loans, and so we have 10,000. Okay. Do you have any question about this month of April? So if you don't have any question, so let's try to finish May, June, and July. Okay. So I'll let you a few minutes to do it. Let's say 10 to 15 minutes. 10 minutes. We'll see 10 minutes. Okay, and so we see from there. And I can give you the amount you should reach at the end of July. This is the amount you should reach. Okay, so I let you 10 minutes to, it's ugly in red, it's too aggressive. Yeah, better. Okay, so this is what we need to reach. So I'll let you try to see if you can handle it. Okay, try to do it by yourself. And we discuss the solution in 10 minutes. So 708, so 10 minutes, 7:18. Okay, and if you have any question, you can ask in the chat or interest of May will be paid in June. Yes, in June we will pay the interest of April, May, and June. So there is no interest paid in May. That's right. So I guess this is what the way you ask the question, I guess this is, you understood. So in June we will pay the interest for May and June because we didn't have any interest in April because we borrow at the end of April. Yeah, so that's correct. So you need certainly to calculate the outstanding balance of the loan at the end of each month to be able to know what you have. Interest of July will be paid in September. Yes, that's correct. So you have, that's made on purpose, right? So you need to wonder what you do with this, right? If it's not paid. In which document do you think it will appear if it's not paid at the end of July? Maybe the balance sheet, right? if it's not paid, it's still a debt. So interest of July will be credit to interest payable. Yes, exactly. Exactly. So in your income statement, you will have all the interest, right? April, sorry, May, June, July, normal, right? Because it belongs to this period. May and June will be paid in June, and July will be in interest payable. And so it will appear in the balance sheet. Yeah. And that will be paid in September, as Hang was saying, asking. Alors, so total asset, so I have, no, total asset, I have 101,596. So if it's balanced, it means you must be okay, but check the difference. So it seems to be 2,000, so you have 2,000 difference somewhere. I don't know where, maybe check on prepaid insurance or wages. Yeah, the ending balance. So, okay, I need to go with firstly the I will come back to you afterwards, right? Okay, so I'm correcting the cash budget. Okay, so let's go for May. So the beginning balance of cash at the beginning of May is of course the ending balance at the end of April. Okay, then for the rest, I think we have already calculated everything. So it means that we have, so that's not correct. Okay, because I forgot this one. That should be correct. So yeah, so if we go for May, so we have, okay, 10,000 beginning balance, which is the end of April. Then we have everything we receive, everything we pay, the minimum cash balance we need to respect. And so we have something which is positive here. So it means that we have an excess of cash of 1,450. So as the company wants to repay as promptly as possible, so as quickly as possible, so we need to repay this amount, okay? So we're gonna repay 1,450. And so we can calculate now a few things. So firstly, so I prepared something for the interest. So we have a loan at the end of April, which is 13,450. And now I repaid back 1,450. So my remaining loan is 12,000. Okay. And for the interest, well, in May, so the borrowing, we borrowed money at the end of April, 13,450. Okay, so that was at the end of April. Okay, so during May, we have this amount. Okay, so for the interest of May, we have 1% of this amount. Okay, and so each time we're gonna have this little difference. And so now I can maybe drag the formula here. So we still have 10,000 at the end of May, okay, because we still have to pay 12,000, right? So we don't have extra cash, right? The extra cash we had, we used it to pay back a part of the loan, but we still have 12,000 to pay at that moment. So we can go for the months of June. For the months of June. So we got 10,000 beginning. Okay, so here we have everything. And so we have an excess of cash of 9,400. The problem is we firstly need to pay the interest. Okay, we first pay the interest. So for June, what do we have? Well, so so we have 135 for May. For June, we have 12,000 times 1%, okay? And so we can see, as it's said here, so the interest of May and June will be paid in June, okay? So these two ones in green will be paid in June, okay? So we're gonna take these ones because we pay interest only every 3 months, right? So we need to pay this 255 first. And so the repayment we have, sorry, it's not very sophisticated, the formula, certainly we can do better, but it's what we can pay back minus the interest we already used. So we can pay back this amount, okay? And so what is the remaining borrowing at the end of the month? We have 12,000 minus 9,146, okay? So this is 2,855. So we still have some money left to pay, some borrowing to pay at the end of June. Okay, do you have any question for the moment before July? So that's right, Kian, your ending balance for the cash is correct. 10, 10, 10, 12, 9, 9, 6. We will see that in 1 second. Okay, so if you don't have any question for July, so I go for July. So July equal to 10,000 for the beginning balance. Okay, so why D19 is 9,146 instead of 9,400? Because we pay the interest, okay, first. Okay, so we have 9,400 available, and firstly we use that to pay interest. So it's like when you go to the bank, it makes sense, right? You pay firstly the interest, and then if you have money left, you pay back the loan. Yeah, so this is how it's calculated. Firstly the interest and then the rest. So we have 10,000 beginning cash balance. No, sorry, 10,000 beginning cash balance 1st of July. Okay, so we have everything we receive and pay. And so we can see that we have an amount available, 5,850, okay, at the end of July before paying back. Okay, so we can pay back some stuff. Let's check for the interest. So for interest, we have 2029 interest to pay, which is the amount at the end of June, 2,855 times 1%. Okay, this is not correct for the moment, this one, huh? It's not finished, but it will pay only in September. Okay, so let's make it another color. Let's say orange. The interest of July, as some of your colleagues shared in the chat, will be paid in September. Okay, so there's nothing to pay here, right? Because we pay in September. We pay every quarter. So we can use everything we want from the excess of cash to pay back. But of course, we're not going to do 5,850 because we don't have that amount of borrowing. So we're just going to say we pay back 2,855, which is the amount of our borrowing which is left. Okay, so there is one of difference. So let me keep it this way so it's more simple. No, 2,854 then. Okay, so we have the amount we were, okay. So there is one difference because it's rounding issue, so please forgive me for this. And so we have the ending balance for the for the cash, which is now 12,996, and we have 0, right? Okay, I'm going to force it. We have 0 for the borrowing, okay? And orange here, it's not paid, okay? So we have to remember this. And do you have any question for the cash budget? We're gonna do another one. Okay, you have a question, Anne? Or I don't know if you mean yes, but because it's understood, or because you have a question. I have a question. Okay, please.
Can you hear me?
Yes.
Can you hear me, sir?
Yes.
So I think I will take time for typing, so I just
Okay.
try to ask directly. Sorry,
Okay.
can you explain again? I don't understand the result on the line 17, assess of cash.
Okay.
May, June, July, I see it's a positive. So why the company decide to have another loan? Because I see that on the line 24, we start to calculate the interest of 12,000. So sorry, I don't understand about that.
Okay, so this line, it's months per month. If we have more cash than what we need or not enough. So that can help us to decide if we need to borrow money. So in April, in April, so we don't have enough cash, right? Or we will not have enough cash because it's a budget. So it will happen in the future, right? So we know that we will need to borrow this amount, okay? And so this amount will be a total amount that we borrow to be able to have this 10,000. Okay, so this excess of cash, it's excess of cash or deficiency. It's always the difference between what we need, okay, what we need and what is available, month per month. So we calculate that month per month. Okay, so for example, in May, we forget everything else. We don't think about the borrowings we have already. We think about the situation of the month. And so about the situation of the month, we can see that we should have more cash. We should receive more cash than what we need. Okay, so it's positive amount here. Here it was negative. So when it's negative, it means we need to borrow. If it's positive, it means that we do not need to borrow. And if we borrowed some money in the past, we can pay back, okay? So since it's positive here, yes, we can pay back, okay? So now we have to remember, was this the total amount of the loan we have? So this is what I calculated here. Here it's like the position of the borrowings that you would have in the balance sheet, okay? So it means what is the amount we have at one moment in time. So if we borrow 13,450 at the end of April, this is what we had. At the end of the month, at the end of April, this is the amount we have. Okay, so if we do nothing here, okay, if we do nothing here, we still have this amount at the end of June, right? Because we did not pay back, okay, anything. So that will the loan will stay the same as long as we don't pay back, okay? So what happens here is that when we have a positive amount in the excess of cash, 1,450, we say to ourselves, okay, I can use this excess of cash to pay back my loan, because this is what the company is saying in the assumption of the case. The company management plans to borrow no more than necessary and to repay as promptly as possible. So the goal of the company is to pay back as quickly as possible. Okay, so this is why we do it this way.
Got it now, sir.
You have it?
Yes, I'm with you now.
Okay, and so here again, just for you and for everyone, it's the amount of the loan which is remaining, what is left to pay, okay? Because it's important, because this is how we calculate the interest, okay? And so the interest, so that's why I did this calculation out of the schedule, out of the chart, because we need to know the position of the loan at the end of the month to calculate the interest of the month. And that's why there is a sort of a time lag of 1 month, right? Because interest of May will be 1% of what was left as a loan at the end of April, okay? Because we consider that we borrow at the end of April this amount, 13,450. That will stay the same during all the months of May. And so we will have 1% to pay of interest on this. And at the end of May, we have this excess of cash I can use to pay back. So we pay back every last day of the month, maybe we pay back something, okay? And so each time we have the position of the loan at the end of May, okay? So 12,000 will be the amount of money we still, which is our loan for all the months of June. And at the end of June, we pay back 9,000 something, okay? So it means that for the months of June, the interest will be 1% based on 12,000, because this is the amount we had during all May, okay? And so on and so on. And so the last thing we have to be careful about is that if I sum the interest, so we get 283 for the interest, okay? So this is the total interest of the period, interest expense, right? But it's not what we paid, right? Because we have an orange status here for the July interest, okay? So just to finish the interest expense, now we can take the interest expense here from the budgeted income statement, okay? So this is 283, this amount here, okay? Now we can finish the income statement. And so we can calculate the net income. Okay, because we just sum up all the interest, paid or not paid. So interest expense of the period 283. So we get net income of. So no, I will not share the Excel file because, as I said yesterday, I want you to build your own Excel file because this is part of your learning process. But you will still have the video, okay, so that you can look again the video. This is possible, but I don't share the Excel file because it's useless if I give you the formula, because you know, from you building your own formula is part of your learning process. So I'm sorry, I won't be able to do so, but you have the video. Okay, so for the income statement, so we have a 2,917. Okay, I think depreciation is 4,000. No, it's 500 times, it's 500 per month, right? Times 4 months. This is what we have. By the way, this is where you have your difference of 2,000, right? This is why you have 2,000 difference. And so maybe we interpret it a different way about the depreciation. So it's 500 per month during 4 months. So for me, it's 2,000, but we have new fixtures. Yes, but they say that the depreciation of these fixtures is already included in the 500. So this is how we must understand. So it's we suppose that the 500 we consider anticipates already the 500, the depreciation of the new. So that's it. So the difference comes from here. So I think you're correct now for the balance sheet because you had 2,000 difference. For everyone. So we still have one document to do, which is a balance sheet. Okay, so this balance sheet. So I'll let you 10 minutes to do it. Okay, and we discuss the solution together. So it's interesting, this document for me, because if you're comfortable with the financial statements, if you understand the link between balance sheet and everything, it will be for you, you know, clear. So I'll let you. Okay, it's 7:36. So let's say 7:45. I come back to share with you the solution for the assets. And Kian was we discussed already with Kian. So if you want to know the total assets you need to have is 101,596. Okay, and so of course this is the amount you should have also for the liabilities and owner's equity, because as you know, your balance sheet must be balanced. Okay. Okay, so I'll let you 10 minutes to do it. If you have any question for anything, you can ask in the chat in between. And if not, well, we see the solution of the balance sheet in 10 minutes, and we finish with this exercise. I think the most difficult part is the cash budget we just finished. We will do another exercise today. We finish tomorrow. A little bit more complicated with the cash budget as well. And so I think you will be ready for the budgets. Okay, so let's come back to the solution. So for to build our balance sheet, so we're gonna use both the information from the beginning balance sheet that we had here. Okay, and so we go from this beginning situation. As you know, the balance sheet is a static situation. It's like a photo of the company at the beginning and at the end of the period. So this one was a photography of the situation of the company um, on the 31st of March. And so we're gonna sometimes use this to be able to build our balance sheet at the end of July. For example, for the fixed assets, we're going to use this information, right? We have 37 at the beginning, then we buy 3,000. And for the accumulated depreciation, we have 12,800. And then we have 5 times 500 that we depreciated during the period. So here it's 37 plus 3,000. Okay. Sorry, I'm not sharing, I guess. This one. Yes. Okay, so that is 37 plus what is invested in April. And for the accumulated depreciation, it's 12,800 that you add at the beginning plus 500 times 4. Okay, so beginning amount plus 4 times 500. Do not hesitate to ask a question when I'm doing it, right? If you have any question, you can say by the chat, or if you feel more comfortable and tired of typing, you can open your mic and ask the question as Anne did. For me, it's no problem. Huh? So this is what we have for the fixed assets. Okay, so it's 40,000 minus this. So this is 25,200. Okay, I put everything in the total actually, so it's pas grave. For merchandise inventory, well, this is our, okay, sorry, where is, so 40,000 coming from? So it's 37,000 that we have at the beginning, okay? Plus the 3,000 we invested in April. 37, so 37 comes from the beginning balance sheet here. Yeah, so that's what I was saying, right? Sometimes we need to understand that the balance sheet we have at the end of the period is the balance sheet we have at the beginning plus or minus what happened during the period, and then this is a situation at the end. So sometimes we need to take into account the situation at the beginning to add it up. Actually, this is what the accounting do, right? Every time you begin to do the accounting of a period, you begin with bringing into your accounting the what you had, you know, at the end of the last period, right? Because the balance sheet is it's cumulative, right? It's a cumulative situation of what you possess and the debt and the shareholders' equity. Okay, so this is it for the fixed assets. So for the merchandise inventory, maybe I'm going to put it here. Sorry, so it's better details and total. So for the merchandise inventory, so this is our ending inventory at the end of July, right? So this is something we can pick up somewhere here. Should be that. Yeah, so balance sheet. Okay, so our merchandise inventory is finally our inventory is actually the ending inventory we have at the end of July. Unexpired insurance. Well, for this one, we need to come back to what I call my blackboard, right? That must be somewhere, hopefully. Let me find it. I'm quite sure I opened it, but I have so many files open at the same time. Okay, so I have to maybe open it somewhere. So give me 1 second, please. 2 screens are still not enough not to be lost. I was sure I opened it before beginning the class, so I don't understand what happened. Financial control. Financial control to 2020 Blackboard. Okay, where is it? So it's open somewhere, but I don't see it. Okay, I found it. So sorry, I was talking about the unexpired insurance. So I come back to so you must see that now. Yeah, so we discussed the insurance yesterday. I explained to you 200 expiration every month, and we said that at the end of July, we have the prepaid insurance 1st of April. So again, beginning balance sheet, right? So you can have a look in your PDF documents, so you can see the beginning balance sheet. And then we brought back 4 times 200 in our expenses. So it means that our ending balance must be 1,000. Okay. So this is the amount we should have in our balance sheet. Okay, so you have this one, this Excel file you have, because I share my Blackboard, which is about my, let's say, explanations. So this is 1,000. Sorry, I'm not sharing the file. Okay, I'm back. So this is 1,000. Okay. So far, so good. So accounts receivable, so July credit sales, not so difficult. It's from the operating budget. Well, I should have taken it here actually, but it's not there anymore. So 50,000 times 40%, I guess, right? So it's 50,000 times 40%. Is that correct? 50,000? Yes? Because I remember 50,000 was the sales of August, but maybe I'm mistaken. No, it seems to be July, so it's okay. So 50,000 times 4%, 40%. And the cash, of course, that's the ending cash of the cash budget. Okay, so yes, that's a good opportunity for me to say to you that I don't know, maybe you did different with your professor in Vietnam or other professors. In my opinion, balance sheet is the last document we can do, because we need information from the cash budget. Okay, so we need to do the cash budget before, and we will also need in the owner's equity, we will take into account the profit of the period. So we need also to finish the income statement. So that's not by chance that I put the documents in this order: cash budget, income statement, and balance sheet, because I think balance sheet is the last one we can do. Okay. So again, 12,996. Now you know this amount. I think it's easy to remember. And so now we can calculate the total of the assets. So again, about the details and the columns, the details and the totals columns, I have another version of the solution under my nose, and certainly that will be the one I share with you in the PDF document later on. It's not saying the same thing to learn details and total. So frankly, we don't care. Maybe one day I need to change my template, but this is the way it should be, okay? But what I mean is that I don't want you to lose time, try to think about what is a good column to put the amount with, because it's finally not important. What is important is how you calculate the amounts, okay? So this is it. So we have the assets. So the assets 101,596, okay? So for the owner's equity, so same thing than maybe I can anticipate the question here, owner's equity. So we're gonna have a look at what we have at the beginning of the period, okay? So the owner's equity at the beginning of the period is 78,950, okay? So certainly we're gonna take this amount and we're gonna add, so 78. I'm gonna put it here directly, 78,950 plus the profit we find, okay? Plus the profit we find here, okay? So that's owner's equity, so that's 78 plus the profit of the period in the income statement. I have another file with the solution. That's why I copy paste some formula, because I recreate with you every time so you can see how it works, but I have the official solution somewhere. Accounts payable, 50% of July purchases, so no big deal here. Purchases of July, so this is it, times 50%, okay? So that's 14,700. Wages and commission payable, so this is 50% of the wages and commission of July, this one, 5 times 50% as well. Interest payable, so sometimes this is the one you forget. So interest payable, so it's the interest of July paid in September, okay? So this one, I can just pick it up somewhere here, this one, okay? July paid in September, orange, sorry, here. I hope by taking the amount, maybe I will have a rounding issue, I don't know yet. So total of my current liabilities is this amount. So this is the amount I put here also. And so I can sum up the two things. No, that's correct. That's balanced. And so we have it. We have our balance sheet, which is balanced. So do you have any question or any amount you would like to see again? You can use the microphone. I'm totally okay with that. If it's more convenient for you to ask a question with the microphone, it's okay. If we save time with that, if you prefer to use the chat, it's okay as well. So you have the video, okay? So I have same amount, so happy. Okay, bravo, Kian. It's okay for Hung, okay? Again, you have the video which is recorded, which is different, right? So it's one of the good things with the online experience is that you can look again at the class. I'm not sure it's a chance for you. Maybe it's boring to look several times, but at least you can check for one specific explanation. Also, I will also give you not the Excel file because I want you to build it by yourself, but I will give you a PDF version of the solution, okay? So you will have at least the amounts in a PDF version. So you can see also. So these documents that we're just doing together, I will give you a PDF version of. Can you share where? It's 2917 here. Okay, 2917 is here. So this is the net income. So this is, we calculated the operating income before, and I said that now that we yeah, so that's with the interest. So that's why I was saying that we need to do the cash budget and the income statement before doing the balance sheet, because we need to pick up information from the cash budget, and we need here to pick up information from the income statement. So that's why usually I say that the balance sheet is the last document we can do, because we need to do other documents. Sometimes in accounting, what we learn, I remember I learned that when I was a student, is that sometimes we do the income statement on one hand, so we calculate one time the profit, and then when we do the balance sheet, to balance it, we need to calculate a second time the income statement, the profit, and it needs to be the same. Can you show how interest expense C39 is calculated? C39, I'm not sure you're talking about C39. Can you show how the interest expense C39 is calculated? So C39, this is it. So I'm not sure this is the one you want, because it's not interest expense. The 5,000 D43. Okay, so this one is actually this one. So I can come back here. That's the interest of May plus the interest of June. These two ones we paid here, okay? And this one is the interest of July, okay? And the interest of July will be paid in September only. But in our income statement, we need to take into account all the interest paid or not paid yet, because all the interest expense are the interest of the period. So the 283 represent the interest of May, the interest of June, the interest of July, even if May and June have been paid, but July will only be paid in September. Is that okay for you, Tom? Okay, so how to calculate wages and commission 5,000? So if you remember what is said in the case, it said in the case that wages and commission are paid semi-monthly, okay? So 50% during the month and they are earned, and 50% the month after, okay? So when we come back to July, here, July, wages and commissions, the total is 10,000, okay? For this total 10,000, we pay 5,000 here in July. So that's the 50% that has been paid directly. And so this 10,000, there is 5,000 out of it, which is not paid yet, okay? So we need to put that in our balance sheet, because it's going to be paid the next period, okay? So that's why that's what the balance sheet is about, right? It's to keep all the events that occurred, but for which we did not do the payment yet. The wages of July, yes, we say to the employees, we need to pay you 10,000, but we paid only 5,000. So we have a debt towards them of 50%. So coming back to the chat, the next question was, can I see C60, please? C60. Owner's equity, yes. So this one is owner's equity at the beginning of the period plus the profit, okay? So it goes back to what we have in the balance sheet. So we are back to the beginning balance sheet. So we have this amount, owner's equity. which is the owner's equity at the beginning of the period, okay? 78,950. So what is owner's equity again? It's the share capital. So it means that the money the shareholders brought into the business, okay, and you give them shares, you know, as a counterpart. And then maybe you know, but owner's equity is the debt of the company to the shareholders. So all the accumulated profit which are not paid in dividends will be accumulated in the owner's equity. So basically, at the end of March, 78,950 is the amount we owe to our shareholders, okay? Which is about the money they brought into the business at the beginning, plus the accumulated profit that was not paid as dividend for the moment. And so what happened in from April to July is that we do not pay any dividends, okay? So the owner's equity, which is the debt of the company towards the shareholder, will be what we have at the beginning, plus the profit of the period, the profit of the period that we just calculated in the income statement. So this is how we do it, okay? Because this profit is an additional value of the shares of the company. Okay, so that's why when you evaluate shares of a company, sometimes you say a first approach would be to have a look at the owner's equity. Okay, it's the book value of the shares, because this is the money that people brought into the business at the first place, share capital, plus all the accumulated profit, which are called retained earnings, right? So this is what we have here. I think I answered to all the questions. One new message: why accounts payable equal 14,700? So it's, as it said here, it's 50% of the July purchases. So same thing, if we come back to what we have in the case. Okay, the company pays 50% of the purchases is the same month and 50% the next month. So certainly in the balance sheet, we have the 50% of the next month. So we need to go to check on, the purchases of July, okay, 29,400, and certainly the accounts payable will be 50% of this, okay? So this is what we have. If we go and see on the formula, so it's this cell that I just showed times 50%. Yeah. So it shows, when I see your questions, I tried, when I show you the answer, to go back to the source of the information, because I can feel that it's still for you not easy to navigate from one document to the other. Beginning balance sheet, ending balance sheet, income statement, the part which is paid, the part which is not paid. So that's why this case is interesting, because it leads you to work on the link between the three documents. Two more questions. How to calculate total current liabilities? Well, it's simply the sum of the three current liabilities that we have: accounts payable, wage, commission payable, and interest payable. And the second question? Has thought wages and commission payable should be equal to 5 plus 5,750. No, it's no, I think it's 2. No, it should be equal to 5,000 plus, okay, I don't know what you refer to. No, because you confused with, so this is the disbursements, okay? So 5,750, this is a 50% left from the previous months. So this is 50% left from this one, from, okay? So this green thing, you can see the green one, 11,500, it's paid here and here. So it's finished. It's finished in July. So we cannot have it in the wages payable. It's finished. The red one is finished, the blue one is finished. So you can see all so blue, red, and green are finished. The one which is not finished is a gray one. Okay, so this is 10,000, which is 50% of 10,000. It's 5,000 that's going to be paid next month. So one more. So what's the difference between July purchase and E11? So E11, are you talking about E11 here? So what is the difference between July purchase and E11? So this E11 here is the amount we pay in July. So this is what you... Okay, so this amount here, I'm going to put it in orange. This is this amount. Okay, so it comes from the budget of the disbursement. So this is the purchases that you pay to the supplier in July. And July purchase, 29,400, is the amount that you buy to the supplier, and they give you a bill for this. Okay, so you go, they give you merchandises, but they give you a bill to pay, and this bill will be paid partly this month and partly the next month. So the two things are different. So the 29,400 represent the purchases you made in July independently from the moment you pay them. And the 32,900 is the cash you pay to your supplier in July, which is a part of the bill of July and a part of the bill of June. Yeah. Okay, so the question you ask is really the difference between the moment we put things in the income statement and the moment we pay things. Okay, so we really have to make the difference. In the income statement, you will have expenses and revenues about what really happened during the month. Okay, you buy, you sell. In the cash budget is only about what you pay and what you receive in terms of cash. So that can be different, right? Because sometimes it takes you time to pay, and it takes you time to receive the cash. Okay, so that's why this case is interesting, because it's a good training for you about the, yeah, you're welcome. So it's a good training for you to, this is why I choose it. It's not complicated, but what is complicated for you, and I can feel, is when you need to build the balance sheet, income statement, and cash budget. And this is why it's really important for me to do that with you. It's good training. So, you know, again, sometimes maybe you have other courses before mine when it's normal MEBF. So these things, I'm sure you're gonna rediscuss with other professors later on, maybe with Eric Maton, maybe with Professor Chevalier. So you will have other opportunities to train about this. One more question of yesterday lesson, Prof. Yes?
Can you hear me?
Yes, I can hear you.
I'm lazy to type, sir, because
Okay,
I think I'm also confused what I try to ask, but can you go back to the sheet of operation budget?
Mm-hmm.
At the column F of the beginning inventory for the total, because the number are quite similar with the result of July and April. Mm-hmm. So I resumed from your video record yesterday, and I realized that the inventory, that inventory number in column F you get from April, right? But not July, is it?
Yes, yes. Yeah.
Can you explain, because for the April, for the beginning inventory, you got the number from the balance sheet of March, but actually from the total after July, we get the number again for April.
Yeah,
So
understand.
that I'm a little confused, sir.
Okay. Actually, in this total period, what I do here, I do the same logic that I do for 1 month, but I do it for 4 months. So here I say to myself, this is a summary of what happened between April and July. So, you know, if I do for 1 month, for example, if I do for April, I say this is the inventory I want at the end of April. Okay, plus this is what I need for April, minus this is what I had at the beginning of April. I guess you get that, right? This one you get. So here I do the same thing, but for 4 months. This is for 4 months. Okay, because it's a summary, it's a total of the period. Okay, so I do it for 4 months. So what I say is that this is what I want inventory at the end of July, at the end of July, and the end of the 4 months. Plus, this is what I need for the 4 months, April, May, June, July. Okay, minus what, this is what I had at the beginning of April, at the beginning of the 4 months. Okay, and so this is the total I need to buy for the 4 months, April, May, June, July. So this is the logic. You get it now, or you want me to re-explain? Firstly, this one is not very important because we don't use it directly in the calculations. Okay, it's just to make it complete that I do this, but the logic is more important months per month. So I have, this is the ending inventory I need to have at the end of May, plus this is what I'm gonna need to use during May. So this is the total I need to have in May, minus this is what I had at the end of April. So this is what I need to buy for May. Okay, so this is the logic months per month. And here, we don't use that directly in the financial statement, so it's just like a summary. So this is the inventory I need to have at the end of July. Plus, this is what the raw materials I will use from April to July. So this is all the total I need from April to July to have in terms of raw materials, 210. Minus, this is what I had at the end of March, so beginning of April. So this is a summary, 162 represent the total amount of materials I will need to buy between April and July. You get it, or you have another question, or you want me to repeat? Okay. And again, it's not very important because we don't really use it. It's just because I have a total column, I try to fill it. But finally, what is important is the months per month explanation. This is the one which is important. Any other questions about this case? Okay, so no further questions for me. Thank you. Okay, so I guess we can finish here for the first part. So it's 8:19, so 8:39 we go back and we move to a little bit of theory and a second case, which is like this, but maybe a little bit more complicated. But maybe you'll see. I mean, if you're able to do this one, you will be able to do the other one. So, okay, so enjoy your break for the moment. And so we talk in 20 minutes, okay? Okay, see you in 20 minutes. Okay, so it's time for us to begin the second part of the class. Okay, so let's move on. So I'm going to share the PDF version of the theory. Okay, so we were here, right? We discussed the different steps of the budgets, and so we said, okay, now it's time to do the Gordon Company case. As I said, this seminar about financial control is more based on cases plus a little bit of theory, but more cases oriented. So I'm gonna discuss a few more topics to complement what I said about the theory, and then we will move on another case about the budgets. So what I wanted to discuss with you now to add to the discussion is what we call the responsibility accounting, which is the fact to to understand that what you just sorry, can you, somebody in the chat can confirm that you can hear me and see me? I'm always afraid because I can, it's, yes, okay, thank you very much. So yeah, so as we did, the budgets, okay, we can calculate them, but we have also to imagine how we can organize them so it's helpful for the company, for the organization. So a way to structure them very simply is to organize them according to some responsibilities that you have within the firm. Okay, and so usually that will link to centers that are called responsibility centers, for which one manager will be responsible for something, right? A part of the business, a segment, an activity, and for which, so the manager is accountable for. Okay, so you're responsible for this. Okay, so the budgets will be used as an interface between the manager, who is responsible for the unit or for the activity, and the top management. Okay, so the top management set goals to the person, and the person knows what is responsible for. Okay, maybe to make it more clear, we can discuss what are the typical four type of responsibility centers. And maybe I will try to link that with one of my experiences when I've been teaching to, we developed in ESCP a program to teach to Disneyland managers, the let's say accounting and budgets. So these people that we were training were usually not very finance people. They were like responsible for one hotel, or responsible for one park, or responsible for, I don't know, some other things. And so it was interesting because when we were discussing with them, we could feel the way the company is organized. Like, for example, the hotel manager was only responsible for the cost. It was a cost center, so he was responsible only to get to keep on budget the wages of the employees, and let's say all the resources he was using to do his job. But he was not responsible for the revenues. He was not, basically, he had an income statement he was responsible for, but he could not see the revenues of that income statement. He could see only the costs, okay? Because the top management wanted him to focus only on the cost, okay? So it's interesting that we understand things like this exist, because it's very different from one company to the other. So in Disney, for example, there were revenue centers as well. So people who were working, for example, in the marketing department, they were responsible for online ticket selling to, I don't know, Russia, or Middle East countries, or Eastern Europe countries and so on. And so they were just trying to see how they can manage to sell more and more and more tickets to groups in these areas of the world. And so they had budgets which were reflecting that. And these guys, they didn't have any cost in their budget because they were only focusing on the revenues. Revenue center, cost center belong to profit center, and profit center belongs to investment center, or are they separated center? So it depends actually on the organization. So in Disney, for example, you had cost centers and revenue center. You don't have profit center, okay? In some other organization, when you have, for example, one manager who is responsible for one business unit, so he will be responsible for the revenues and the costs. So it will be, responsible for a profit center. So let's say that we can say that you can have companies for which you will find managers who are only responsible for costs, and so there will be cost centers, only responsible for revenues, so that will be revenue centers, and some other companies with a different organization will take the guy responsible for everything at the same time, revenues and costs, and so the person will be responsible for profit center, okay? So these three first ones are actually quite going together, cost center or revenue center or profit center. And investment center is different because investment center is usually a person who is responsible for everything at the same time, okay? So investment, revenues, and costs. So in addition to be responsible for a profit center, you will also be responsible for the investment, so the capital expenditure. Okay, so when we go down, we include more and more things. So in companies, you don't have one or the other, or you have cost center and revenue center. That would be a first part of organization. In other company, you will have profit centers, and in other company, you will have investment centers. The IT company I was working on was like this. You had profit centers, so people were responsible for one subsidiary, let's say, and there was one person who was totally separated, who was responsible for the investment budget only, okay? And so Disney, it's more cost center and revenue center. So it really depends on the organization. Okay, so the question, do revenue center and cost center belong to profit center? No, there are two different types of organization. So in some companies, you will have revenue centers and cost centers, and in other companies, you will have profit centers. It depends on what you want. Yeah, it depends on what you want your manager to be responsible for. I guess for Disney, again, they did not want the guy, the manager of the hotel to deal with revenues, because the revenues of the hotels were mainly booked online, okay? So they didn't want that person to focus on the revenues. They wanted the person to focus on the costs. Maybe to some extent they did, you know, it's a way also to make people blind about one specific type of information. So the person is not, I don't know, and the finance department is the only one who is aware about the profit margins, okay? It depends. Profit centers is like you give more responsibility to the manager, and even investment center even more. But the typical scenario is that you have a profit center, I think, I would say, in a lot of different companies. So people will manage their income statement, okay, and there will be a separate budget for investment decisions. Okay, so that's important. And so finally, we will discuss a little bit that in the next case. Of course, in the responsibility accounting, so it enables so they are all under finance division, but separated centers to different control purposes. Well, it's different. It depends. So it depends, because in some companies, the centers will be like a production center, right? So the guy who's gonna do production, it has nothing to do with the finance division, right? He is a production center, okay? So he will be responsible for cost and revenues, and he will interact with the finance division. So the finance division, which will be usually linked to the headquarters, will give the budget to this person about the goals the person has to reach. The person will do the operations and then will provide some feedback to the finance division. Okay, so usually finance division will be linked to the headquarters, and any profit center will be like a business unit which is separated from the finance division. It's more like this. Okay, and sometimes in more developed activities, in more developed businesses, you will have maybe one manager, one accounting manager in each of the business units. Okay, so that will not be in the headquarters, but there will be also a person within the business units. So they are all under finance division, but separated centers for different control. So I think we can say that. You know, it was interesting. I had this situation in another teaching project we had with a big company in France. Is with Orange. So Orange is it's like Vinacom. So it's like you know, all the phone companies in France. And so they were thinking, so that they had this question. They were thinking. We were teaching to the management accounting people, controllers, and so the top management was wondering, should we put these people physically in the headquarters in Paris, the controllers, the management accountants? Should we put them physically in the headquarters in Paris, or should we put them locally in the different business units in Poland, in the south of France, in Spain, and so on and so on? Is it better that the people who are gathering cost information are on the field with the different business units? Okay. Or is it better that these people are in the headquarters and send the information to the business unit? Okay. I'm talking about the top controllers, okay, the top manager, the top controllers. And actually what they decided is to have the controllers in the headquarters in Paris, because they wanted that the controller is more daily in contact with the top management than with the business units. They were fearing that if the people are in the business unit in Spain, in Poland, and so on, they will be influenced by the business unit, and so they will maybe fight more to have, let's say, you know, to try to obtain more budget and so on and so on. So the top management decided to have the people in the headquarters, like, as you say, maybe like you call the finance division, okay, and so they will spreading the needs to the different business units. By doing so, I think you are maybe more certain that the management accountants, the controllers, they will maybe work more for the headquarters, okay, like in Disney also. But I think what you miss is that these people are not on the field, so they don't see how the things are going physically, okay? So maybe you control more the information, but maybe you have access to less information on the field, okay? So that's a balance you have to find. I don't know if it answers to your question. Okay, so that shows also that there are human aspects in budgeting as well, okay, according to the organization. Because you have to make your budget not only as a mechanical tool, but also as a tool for you to discuss with people, okay? Like I was expressing in the examples I was taking, you know, budgets can be well received or not well received, because people will think about the pressure they receive because of the budget, for example. So it really depends. So we have to remember that the budget is also a question of, you know, good communication. Okay, so when you talk about when you build a budget, you also need to get some feedback from people and so on, and you need to discuss the budget with people, so everybody understand why we have such a budget. Like maybe especially in a time of COVID, for example, we can imagine that you will have to explain to them why you have to reduce the investments, or you have to sell more, or you have to save some money, or difficult decisions to take. And so budgets needs good communication over it. Okay. And sometimes what happens also is that you have what we call the budgetary slack. It's usually a result of not so good communication, because you're going to build the budgets to be too easy to reach. Okay. So because you want, the budget to be easy to be reached by people. Okay. So that's good for, let's say, a good atmosphere in the firm, but it's not optimal on a profit wise, right? So you have to be careful not to get into this. To avoid this, well, again, it's a question of a good planning and good communication with people. It's also a question of how you set your budget. So where do you take your data? Okay, so do you have good benchmark to take your data from? Are you taking precise information? Also, practicing rolling budgets. I discussed that the first day, yesterday then, when I say that you need to be flexible enough to revise your budget during the year. At the end of January, if you see that your budget was too optimistic or too pessimistic, then you must change the budget for February, March, and everything. So this is what we call practicing rolling budget. It's like you prepare a first version of the budget before the year begins, and then when the year is happening, then you still adjust your budget for the months to come. Okay. And of course, as I was saying, okay, managers involve themselves regularly in understanding what the subordinates are doing. Of course, it's what I was saying, good understanding and good communication. Also, another way, which is maybe some of the things you do maybe in your company, is to use the technology, right, to have a better gathering of information. Like nowadays, a lot of companies, they have ERP systems, right, where you have actually access to information from every part of the company. Because think about what was happening in the past before computers. So if you wanted to know how many kilograms of raw material were consumed, you need to ask that to the person who was in the production department. But this person maybe was not, precise in calculations, or maybe this person did not have the time to gather the information because they were paid to produce, right? Not for the paperwork. And so people sometimes they say, oh, I don't have the time for the paperwork. Okay. So with the technology like enterprise resource planning system, you have access to all the information which is entered in the computers: quantity of raw materials, quantity you buy, which price you buy, how many hours you spend to produce this product, and so on. You can have everything, access to everything. The real question here, I implemented myself an ERP in the IT company, so I know how it works. I know what is important is how are the settings done. So when you, let's say, program the way you're gonna, pick up the information, you have to be sure that you ask in the computer at the right place, right? That you don't forget anything. That's the first thing. Where do you are the processes efficient, and is the way you pick up information efficient as well? Okay, do you understand how it's programmed so you can pick up the information at the right place? And the second thing that was important also was what is the document you will create when you print it out so you have the summary of the information you need. Okay, so where do you take out the information, and what is the template of the document you create to check to make this information appear. Okay, so because maybe sometimes it's you who gonna print out this document, maybe it's your top management, so you really have to think about what is important and not to forget anything. So that's, let's say that with the ERP system you have access to all information in the world you want, but you have to organize the picking up of information, so it's useful for you and you don't forget anything. So you need to check again, maybe when you prepare a document which is about the cost calculation for one product, maybe you have to add all the products to see if the total column represent the total expenses you have in your accounting, so you know that you forget nothing, and so on. So it's a powerful tool, but it needs a very good setting. Okay, and a last thing you can do to, let's say, try to have precise information for the budget is also to do what we did in the previous course, a sensitivity analysis, okay, which is a what if technique, right? And you say, what if we change the selling price for the goods? What if we change the raw material, the cost for one raw material, and so on, to see how it changes your budgets. And then maybe you can have different version of the budget. You can have an optimistic budget, a pessimistic budget. Sometimes it's even more cynical than that. You can have a version of the budget which is pessimistic when you go to the bank, for example, because you want to show them that you need to borrow money. And you can have an optimistic version of the budget when you want to go and see some potential investors who would like to invest in the company, so they see the potential of the company. Sometimes it works like this, but everybody knows, right? So they know that you will present a more optimistic or more pessimistic budget. Usually when I was working, we had at least 3 versions of the budget: the optimistic, the pessimistic, and the central one, the one we were following, which is not so far from what we did in the context of the capital budgeting, right? Because the logic of the sensitivity analysis is the same in the different areas. Okay, so this is what some flesh on the bones that I wanted to share with you for the budgets, about how they built in the real life. So how you didn't tell me if I answered to your question. And do other people have other questions about this? Maybe it links with, okay, so maybe it links with, I'm sure that some of you guys understand what I'm talking about because you experience that in your job. Maybe you are the person, maybe you have every month, you have the pressure to provide information every month, to give information to someone. Can you repeat again 3 versions of the budget, Prof? Yeah, I would say pessimistic, optimistic, and normal. Okay, so the pessimistic would be, lowering the profit. Okay, so that can be interesting if you want to show that budget to someone you need to ask money from, like the bank, or like government. When you need to have some help from the government, maybe it can be good to have the sort of the pessimistic scenario. The optimistic scenario of your budget would be if you need to convince someone that your company is in good shape. So for example, it could be in the case where you want to convince potential shareholders to bring money into the business, or if you want to convince your company that your business unit must be kept or developed. Okay. And the last version is the normal one, which is an in-between, which is usually a document that you keep internal of the company. Okay, and because this is the one people will use to to make their assumptions. Okay, and it's not for to seduce someone, or it's not to convince someone that you need something. It's just for you, just internal reasons. So this one can be, let's say, realistic, and can be used for internal reasons. But again, nobody is naive, so they know that when you show a budget, of course, you know, they anticipate that you're gonna present a pessimistic or optimistic version. So usually they're gonna even correct it right away, because they will assume that you did the optimistic or pessimistic version. So everyone is educated now. So so it's you know, you cannot convince everyone about the versions of your budget. But maybe what we can say to conclude is that even if a budget is something you build up with calculations, it's still more than that. It's still more a tool to convince, or a tool to communicate. It can be a marketing tool, it can be a management tool, certainly. And so it's a tool. It's a tool to express to the people what you want. And our job as a accountant and finance people is to try to build the document which is the most convincing for the context. Okay, if you want to check for the you know, if the company is profitable or not, and so on. So this is what I want you to understand now, you master students. So it's not only about calculation. So you have to understand that budgets and financial information is also of course a question of communication, negotiation, management, and so on. Okay, but it's not always so cynical. I'm not saying it's cynical. I'm not saying that we are manipulating people with the figures. It's not what I'm saying. What I'm saying is that our job, as we are professionals of accounting and finance, our job is to you know, present the information which is the most useful for your company, and for the management, to obtain financing. It's not about manipulating. It's about using our knowledge to be convincing people with what we do, budgets or whatever we do. Depends on you, what is your specialty. And this is the difference between an operation people and management people. I would say management people are more convinced about the you know, the role that the documents play into convincing people, into negotiating, into managing. Okay. Okay, so we have 1 hour left, a little bit less than that. So I would like us to work on the second case now, which is a stylistic case. Okay, so you have this case, and you have already some, you know, reading to do to understand what the situation is. Okay, and I would like that you read it, the first page, and the second page as well. Okay, maybe even, yeah, till this. Okay, and I would like us to so I'll let you 10 minutes to read it, and maybe we can discuss quickly about how you understand the case, about the 5-step process to implement the budget strategy. Okay, you have 5 steps which are discussed. Okay, so I would like you to you know, to pick up the information which I think you think is important. Okay, from the reading of the 2 or 3 first pages. Okay, so it's going to be some reflection, and then we will get into the details of the calculation. But firstly, I would like you to read the case, and maybe we discuss that in 10 minutes. Okay, so 10 minutes from now, it's 9:18. Okay, so you get 10 minutes. Okay, so I think you got time to to read the case. Okay, so do you have any so do you have any information you would like to share in the chat that you that you think is important for this company before getting into the calculations? What do you think you should have in mind, right? What is important for this company? You can share in the chat. Anything? Price of raw materials. Yes, we have this preoccupation. So we have something about here about it somewhere. Okay, so price of raw materials, margin of our operating cost. We have it here. That's true. I don't remember where we have the information about the raw materials. Maybe later. Increase profit by 10% in the coming year. That's true. This is one of the so 12% in operating margin, we find it here. And I think this one you say, yeah, 10% profit growth. Okay. And what do you, yes, maintain 12% operating margin. So how do you think they can increase the profit? What do they say? What do they say about this? What could be important for them? Pushing sales deluxe, yes. So you understand that you have two type of models, right? So we have the deluxe tables business that may be interesting. So what can we say more than that? Is there something we can say about the deluxe model? So they have two models already. So that will be new for us because we had one model in the previous case. So we're gonna work on two models here. And so be prepared that at one moment we will have to think about how we can separate the indirect cost between the two models. Okay. And of course, each model has specificities. And of course, the deluxe model must be higher, right? So the price of raw materials will be about the same as in 2020. Okay, so that's good. If we can, so that means also this is typical gathering information from the budget, right? It means that okay, when we build the budget, we take information out of the company as well. Okay, so we need those raw materials, what the market are saying about this. Okay. Yes. Yes, Ha, you want to tell me something? In the case it said with marketing investment, the price can be slight. In this case, it said with marketing investment, the price can be slight increase, operating costs can maintain unchanged. So yeah, so it means that we have some possibility to increase the price slightly for the deluxe model with operating costs that can be maintained, right? So of course we want to push that, right? Because so this should make them okay. Operating costs can maintain unchanged. So this should make the margin for operating costs slightly decrease, right? So if the price increase and if the cost remain the same, the margin should increase, right? Not decrease. It should increase. if I understand your point. Because we said that raw materials should be okay. Okay, you're talking about the price of raw materials. Okay, the price of direct materials have slightly increased this year, right? But the selling price should increase, okay? And I think somewhere we say that the raw material price should be quite the same. Maybe it's later on. So okay, so this is what we have. Well, so the price of raw materials have been increasing in 2020, but what we are going to do is 2021, the budget for 2021. Okay, so for 2021, we can expect that the deluxe table price, when we sell it, selling price will be would be able to increase a little bit, so we can sell more at a better price. And on the other hand, the price for direct materials should be the same than in 2020, so it should be maintained, right? So I think that should be okay for the operating margin. Okay, the thing is, we have two products, the deluxe and the normal one, the normal one. And so that's why we want to push the deluxe, because the margin is higher usually for products, right? So that should be okay. I think I don't see the problem with your question, because the price of raw materials should be the same in 2021 compared to 2020, and the selling price should be higher. So we should be able to reach the goal to maintain the operating margin, and even to make a 10% profit growth, right? Normally should be okay. My bad, it's my, yeah. So no problem. But if we want to stay with the risks, okay, so we have some uncertainties, right? So we have, okay, on the short term, we have one thing with the competitor. Maybe you saw that. So one of the key competitor in casual had quality problems that are unlikely to be resolved until 2021. So, okay. Unfortunately, they also discovered the price of direct material. Okay. So we have an opportunity also about one key competitor that maybe will not be there for a moment. Okay. But it will come back, right? So we have to be careful. Okay. So it seems also that we have the danger of having significant price pressures on casual table. Okay. Okay, so they do not expect during the first part of the year, but that will increase when it comes back. Okay, so we have to be careful, and that is for the casual tables, right? So it seems that we have a risk with the competitor about the casual table. So maybe that's another reason why we would like to push up the deluxe table business. Okay. And so what do we have still? So that's it. I don't know if you see something else that I didn't discuss. So we have the production process, right? So you must have seen it. So we have some direct labor hours on one hand, raw materials on the other hand. So okay, so we have two types of models, casual and deluxe. Okay, we have direct material, so that will be variable. We have direct labor also. Okay. So that should be also variable. Okay. For the cost drivers, we see that later. It's when we allocate the indirect cost. So it's not a problem for the moment. We will talk about it tomorrow. So let me check what I had in my official solution. just to wrap it up what we said. Okay, so yeah, what I wanted us to not to forget is that we have a five-step process, right? When we want to implement the business strategy, and I wanted to use a case to discuss these 5 steps. So the first is to identify what are the problems of an uncertainty. So this is something you could do for any situation. So we can see 4 preoccupations of the CEO. So the volume of sales, the selling price per unit, the cost of direct materials, and cost reduction through economies of scales. We didn't discuss that. Okay, once we identify problems and uncertainties, we can try to obtain information. Okay, so about the information, we have good news. Sales volume has been stronger than expected, and a competitor has some problems. Okay, and the bad news is that the price of raw materials have increased. Okay, so about the future, we have 2 tables, deluxe and casual. Globally, we believe that the volume can be increased for the deluxe table, and even maybe the selling price per unit too. Okay, so we have with more marketing efforts. About the casual table, no price pressure is expected, at least until the competitors come back. Okay, price of raw material should be the same, production cost should be maintained. So for the casual table should be okay. We just have to look after this competitor, but the opportunity of growing seems to be more linked to the deluxe table, right? So then you identify very clearly, and very soon you told me 12% operating margin, 10% increase in profit. Okay, so you've seen the goals very quickly. And so that should be by pushing sales of deluxe table. Okay, so it means that in our budget for what we're going to do now, the calculations, we should see additional quantity for the selling price. Okay. So to implement the decision and evaluate performance and learn through variances, they should be later on able to check if the forecasts were good, among other things, if the price of both models were good, okay, because especially with the deluxe price, maybe we're going to try to increase it. So we're going to put that in our budget, but then we will check if it really happened in the reality. We've been able to increase the selling prices. What has been the pattern in terms of price of raw materials? Is it the same than in 2020 as we hope? And also, if we want to increase the profit, it's also because we want to improve the processes. So we should check that afterwards as well. Okay. So I guess this is it. Do you see other things to add to this sort of a summary? Okay, so if not, you can go for the Excel template. So I must firstly open it. Must be open somewhere. Here we go. So now I can share. So you have an Excel template, okay, for this case that you can use. So same thing, I will not share the Excel solution, okay? So be careful to build your calculations right. And you can see you get different tabs: revenues, material and cost budget, manufacturing overheads budget, ending inventory budget, cost of goods sold budget, and so on. Okay, so you have information in the case about all this. And that's a summary of what you have in the first table of the Excel file, okay? You have some explanation here, but you read them. So I would like you to work on this first part already. Present the revenues budget, production budget, direct material usage budget, direct material purchase budget, and prepare the direct manufacturing labor cost budget, okay? So that leads us to the 2 first tabs, I guess. Revenues budget, and this thing for which you have different steps here, okay? Should be okay, should be quite fast. So I'll let you a few minutes to do this. Maybe, I don't know, 10, 15 minutes maybe, and we discuss the solution afterwards. I will share, like with the Gordon case, from time to time some solutions. Revenue budget should be quite fast. Just for you, so what you have to fill in is here, right? Just to my advice, one advice, you got the data, right, which are gathered in the first tab. Okay, so here again, you should have only formula like we did last week, you know. Because when you do this, a sensitivity analysis, let's say, oh, what if the selling price is the direct material price is 8 or whatever, it's going to be, you know, it's going to increment itself. Okay, so revenue, material and loss, and labor cost budget. So I give you a few minutes to do so and we discuss. Okay. I'm going to share the revenues budget because I think it's quite simple already. So revenues budgets, of course, you're going to pick up the selling quantity for every product, right? And the selling price per unit. Okay, so this is the total we have. And for the deluxe table, we expect to sell 10,000 units at a price which is higher. And so the revenues for this product should be 8 million. So we have theoretically 38 million normally for the two types of products. Okay, so we sell more of the casual, we sell 50,000 of the casual and only 10,000 of the deluxe, okay? And of course, the selling price is higher for the deluxe than for the casual. In 5 to 10 minutes, I discuss the other budgets. If you have any question, you can ask me in the chat, or you can open your mic and ask the question. I'm here for you. Is that okay now for material budget, or you need 5 more minutes? Two more minutes, please. Okay. Okay. 9:47, 48, I will begin. Okay. Schedule 2, casual 60K. Yeah. $60K, there is 10K. Yeah, that's correct. So I'm going to present this one already. Schedule 2. Okay, schedule 2. So what we want to do here is we want to determine how many units we must produce. Okay. And actually what we do here, it's like what we did in the previous case. Okay, we go backward. So I finish with the schedule 2, and I'll tell you if you're correct. Yes, this is correct, Kian. Okay, so the budget, the number of budgeted units we want to sell, okay? how many units do we want to sell? Okay. What is the targeted ending inventory in units? Okay, so the total required units will be the sum of 2. Okay, so for the casual, we want to sell 50, but we also want to have 11 left in ending inventory. So we need to have 61,000 made, right? Or I mean, we need to have 61, but we already have some left from the previous period, 1,000. So we need to produce the difference, okay, 60,000. Okay, so this is how it works. So I'm going to do it. I could just drag the formula, but I'm going to do it again with the Deluxe so you can follow the steps again. So we want to sell 10,000 of Deluxe. And we also want to have an ending inventory of 500. So we need, the total need we have is 10,500. But we also have in beginning inventory of 500. Okay, so we need to produce the difference. We need to have 10,500 units available for the period. We have already 500 from the previous period in the beginning inventory, so we need to produce 10,000. Okay, so this schedule, production budgets in units, gives us the information about what is the quantity we need to produce. Okay, so this is the first step. Can I go for schedule 3 or is it too soon? You want more time for schedule 3 or can I go for schedule 3? Please go ahead. Okay. Yes, you can go for 3. Okay, great. So now we need to schedule what is the amount of the direct material budget we need to have. Okay. So for this one, we need for the casual 60,000 units times the number of red oak we want to do for the casual granite table. So that's 720. Okay, so that's for the red oak we need. Okay, so for the deluxe we need to produce 10,000 units, and each time we produce 1 unit, we need 12 units of red oak, 12 board feet. Okay, so that's 120. What is the price we're gonna have for this? Well, we have the price here, right? $7. So same thing here, of course. Okay. So the quantity we need for production is, of course, the addition of the 2. And here, be careful and do not add. We're gonna do it afterwards. So for the total in dollars, it's gonna be like this. Okay, 720,000 units. Okay, so the total would be in dollars 5,880. And so maybe we can calculate the cost by doing the total divided by the quantity. Okay, so that's 7. Okay, so the average cost is 7 because we have the same price already. So the targeting ending inventory we want to have is actually 11 time, sorry, the targeting inventory, we have it here. Targeting inventory in quantity for the red oak, it's 80. Okay, same thing, huh? Still 7. And so the total we need is the addition of the 2. Okay, and the beginning inventory we have in quantity is here, 70. So the purchase we need is this minus this, so it's 850. Okay, each time it's 7 because we have fortunately the same price, so there is no complication here, and we can just multiply here. Okay, so total needed is this plus this, and beginning inventory, so this time this, and so we need to purchase the difference. So for the red oak, the first raw material, we know that we need to purchase 850,000 in units in board feet, okay? And the budget we need to put for our purchase is around 6 million, okay? $6 million. So I can do the same for the granite, so which is the second type of raw material. So we need to produce 60. Each time we produce one. For the granite, it's 6 units, okay? For the deluxe, we need to produce 10,000 units of deluxe, and each time we do 1 unit of deluxe, we need to put 8 square feet of granite, okay? For the targeting and ending inventory, we have the information here. We want to have 20 at the end of the period, just in case, and the beginning inventory is 60, okay? So the price is 10 and it doesn't change, okay? So it's going to be 10 each time, okay? So maybe I can, okay. So here, okay, let's do it, quietly, okay? So the total is this. Total is this, so the sum is this, and so the average is 10, okay? It's going to be like this now. $10, sorry, for 20,000 units that we want to have in the targeted ending inventory. Okay, and for the beginning inventory, it's 10 again. And so it's going to be 600. Okay, and so what we need is this minus this, so it's 400. Okay, minus this. Okay, so this is for the schedule 3. Can I go for schedule 4, or do you need more time? It's very easy. Yeah, schedule 4. Schedule 4. Okay, so firstly, I forgot to add the 2 here. Okay, so I think I can drag the formula now. If it's okay, I think it's okay. You tell me, I don't check. And so for the direct labor budget, so it's a number of hours. So how many hours do we need for casual? So for casual, we need 4 hours. Each time we do 1, and we're gonna do 60, right? So we're gonna have 240 hours for the casual. For the deluxe, we're gonna have 10,000 products to do, and each time we make one product, it takes 6 hours, so 60 hours, okay? So we got a total of 300. And what is the cost per hour? It's the same for the different products, okay? What would change here, the quantity we need, the quantity of hours we need. And so then we have this budget also finished. Okay, 2 minutes for schedule 4, please. I think we are nearly finished here. It's 9:59. So I'm gonna erase the schedule 4. Okay. We're gonna stop for today. And I will do it again tomorrow. knowing that you can check on the video because it's already done. Okay, so that will be the introduction for tomorrow. Just before we leave, I would like to ask you something. So we save time tomorrow. If you just give me time, I would like to come back to the case to conclude for today and ask you to read something. So I would like you, please, for tomorrow. So because we are nearly finished step 4, so I will correct step 4 as an introduction tomorrow, okay? And so I would like you to read step 5, okay? Step 5, so read this page and the next page, okay? Till step 6, okay? So you got 2 pages to read. Not so easy because it's about indirect cost. So I would like you to read because it's going to take time for us to discuss that again. So we have a question. Can I ask if cost per unit is different between casual and deluxe? Cost per unit is different between cost per unit. Which price we use to calculate targeted beginning inventory? Do we use average price, Prof? For I think so I think you're more talking about the price, not for casual or deluxe, but no, I don't understand your question because we have, so firstly, okay, so firstly, for the direct material inventory, they use first in, first out, okay? So that would mean that if we have a difference in the price between the casual of the last period and the casual of this period, we should need to do first in, first out, okay? Of course, the alternative would be to do an average price, but it depends on companies. As for the casual and deluxe, we are talking here about the finished products. So, of course, the price is different between casual and deluxe because it's not the same product. And for the targeting beginning inventory, we have, I don't understand your question. I don't understand your question. So for, yeah. So, okay. So if we are talking about the raw materials, meaning the red oak and granite. So if we have a price 7 here, but we have a different value for the beginning inventory, okay? Beginning inventory in units, in dollars, sorry, then we would do first in, first out. So meaning that we would use firstly the beginning inventory, then we use a part of what we bought during the period. Same thing for the granite. For the for the casual granite and casual and deluxe tables, so we have an estimation of the value here. Okay, beginning inventory is 380 is 262. Okay, so for 1,000. Okay, so we can calculate the cost, but when we are talking about the valuation of the inventory for finished goods, such as the casual and the deluxe table, it's the production cost, right? We're going to use. It's not the purchase cost. And so this is something we do tomorrow when we do the inventory of the product. So that will be the step 6, I guess. So I think if I understood badly your question and you, so or you're talking about the raw materials, and so I answered. And if you're talking about the finished goods, I think we will see that tomorrow when we do the ending and ending inventories for the finished goods. I don't know if I answered to your question. But for the in and out of stocks of inventories, we have two methods, the first in, first out, and the average. Okay, so it depends on what you have in your case. So here it's first in, first out. But since the price of the raw materials is the same previous period and this period, we don't care finally in this typical example. Does it answer to your question? Okay. Sorry, I've been trying to, I hope but you can still ask questions tomorrow if it was not clear. Okay, so please read step 5 on the PDF documents to see how we allocate the indirect cost, because it's quite tricky. So I would like you to have a look to see if it rings a bell between with something you did in the past. Of course, I will re-explain it, and I will begin the session by doing schedule 4 again. Okay, so for some people who wanted to have some more time to do it, I will do it again, and these people can take the time before tomorrow to finish. And so I think it's time to go now. It's 10:06, so I let you go. And so we keep on going with this case tomorrow, as you understood. Okay, so you can read the case. Please read at least step number 5, and we will keep on going with the different Excel tabs tomorrow. Okay, so this is it for today. Enjoy the rest of your evening. Good luck for tomorrow for work, and we meet again at 7 p.m. for Vietnamese time for the next steps. Okay, good evening. See you. Cảm ơn. Xin chào. Yes, you guys stay safe as well. Okay, take care of your family, take care of your loved ones, and be careful when you go to work. Okay, see you tomorrow. Bye-bye.